Welcome back to the deep dive. We have a serious stack of documents on the desk today.
We really do.
Usually, when we sit down, we're trying to parse a week's worth of news, maybe a quarterly trend, looking for those little signals in the noise.
Right. The small stuff.
But the research we're looking at today, it just feels different. It feels like we are looking at a specific moment in time where the tectonic plates actually shifted.
It really does. You often hear phrases like paradigm shift tossed around in financial media. And usually it's just noise, right? It's marketing fluff.
Yeah, totally.
But looking at this report from Morning Finance, focusing on late January 2026, the ground has genuinely moved.
We're talking about the post-Davos hangover, essentially.
The post-Davos reality check is what I'd call it.
Right, because if you look at the market mood just a few weeks ago, before the summit, it was hard to find a bear on Wall Street.
Oh, impossible.
Everyone was betting on a smooth ride, soft landings, the whole 9 yards. And now we're looking at a report that details a massive sell America rotation.
It's a complete flip in rhetoric.
And volatility coming back with a vengeance.
It's a shock to the system. For the last few years, investors have been sort of lulled into this sense of predictability. Even with all the political noise, the market just kept chugging along. But the core thesis of the research we're breaking down today is that the rules of the game have fundamentally changed in the last, let's say, 300 hours?
300 hours.
We aren't just seeing market fluctuations. We are seeing a structural shift in how the global economy functions.
So our mission today is to decode this new global order. We need to understand why globalization isn't just cracking, it's shattering.
That's the word for it.
We're going to parse the upcoming tech earnings that are basically going to define the rest of 2026. And we have to talk about why holding cash might be the riskiest move you can make right now.
It's a paradox, isn't it? Cash feels safe. It feels like a bunker. Right.
But in this specific environment, it's just a melting ice cube.
We'll get to that. So we have 4 key pillars to get through today. First, the macroeconomic fracture, why the dollar is sick and gold is, it's exploding.
Yes.
Second, the political situation in the U.S., specifically this shadow president effect on the Federal Reserve.
That's a huge one.
Third, a trade deal that nobody in the U.S. is talking about, but is literally rewriting the map of global commerce. I'm talking about the EU-India deal.
That one is a sleeping giant of a story. It is going to have ripples for decades.
And finally, we have to talk about the tech titans. Tesla, Meta, NVIDIA, because the way they are behaving, they aren't just companies anymore.
No, they're evolving into something else entirely, kind of like nation states in a server rack.
I like that visual. So let's jump right into the deep end here. Let's unpack this concept of the macro shift.
Let's do it.
Okay, so one of the things that jumped out at me immediately from the source material is the terminology, the words they're using.
For years, we've heard about deglobalization or fragmentation, and those sound manageable, like a slow drift.
Right. Fragmentation implies pieces slowly drifting apart, like ice sheets separating in the Arctic. You can see it happening. You can calculate the drift. You can adjust your course.
You can build a bridge.
You can build bridges between the flows. Exactly. It's slow. But the expert analysis we're looking at today uses a much more violent word, fracture.
A fracture. That sounds painful and immediate.
It is immediate. A fracture is a bone breaking. It's a sudden structural failure. We are no longer talking about a conscious uncoupling of economies where everyone shakes hands and trades a little less.
Yeah.
We are talking about a hard break that is forcing an urgent rethink of everything. Supply chains, partnerships, automation. The source material actually calls it an existential crisis of sovereignty.
Existential crisis of sovereignty. That is heavy language for a financial report.
It really is.
So, okay, strip away the academic wording. What does that actually look like for a business owner or, an investor listening to this?
It means you can't rely on the old alliances at all. If you are a manufacturer, you can't assume you can get parts from country X just because you could 5 years ago or even 5 months ago. It's that fast.
So the whole just-in-time supply chain model is...
It's dead. It's a relic of a past age. If supply chains are fracturing, you need to own your production. That's why we're seeing this desperate rush into AI and manufacturing automation.
It's not just about efficiency anymore.
No, it's about survival. It's existential. If you can't make it yourself, or if your partner is on the wrong side of that fracture line, you're dead in the water. You're essentially realizing that you have to be your own island.
and that brings the volatility.
Yeah.
But the source makes an interesting point here, that volatility isn't necessarily bad.
Right.
We're conditioned to think, volatility equals fear. Volatility equals loss.
That's a common misconception, and it's a dangerous one. Volatility is just information. That's all it is. It's the market repricing reality at high speed. Prices are moving fast because the facts on the ground are changing fast. If the world changes and prices stay the same, that is actually dangerous.
Because it means the market is in denial.
Exactly. The market is asleep at the wheel. Right now, the market is waking up. But it requires a completely new approach to risk. You can't just set it and forget it like you did in the early 2020s.
Speaking of risk and setting and forgetting, there is a stat in this report from Invesco that, honestly, I had to read it 3 times. I actually thought it was a typo in the PDF.
I think I know the one you're looking at. Is it the correlation data?
The correlation data. So let's go back to Finance 101 for a second. The whole point of diversification, the reason you don't put all your eggs in one basket, is that you buy different things so that if one goes down, the other might go up or at least, stay flat.
The basic principle.
The basic principle. And back in the 1990s, the correlation between the U.S. and European markets was near zero. They were independent variables.
Right. That's the definition of a healthy portfolio.
Yeah.
You buy the S&P 500 for U.S. growth, and you buy the German DAX or the French TAC to hedge against U.S. risk.
Yeah.
If the U.S. tech sector gets bubbly and bursts the German industrials, they might just keep chugging along. They're on different tracks.
Exactly. But today, according to Invesco, in January 2026, that correlation is at 98%.
But it's a staggering number, 98%. I don't think people realize how crazy that is.
I don't think I did.
It means, for all intents and purposes, the U.S. and European equity markets are the same trade. They move in near-perfect lockstep.
So if I'm sitting here thinking, well, I'm worried about the U.S. election or the U.S. economy, so I'll put some money in Europe to be safe, I'm basically doing nothing.
You're deluding yourself. That's what the data says. It's the illusion of diversification. You might own different company names. You might hold Siemens instead of General Electric. But the liquidity flows driving them, the big money, it's identical.
It's all the same river.
It's all the same river. The algorithms that control the vast majority of trading don't see them as different regions anymore. They see them as Western liquidity. If the U.S. sneezes, Europe catches the exact same cold at the exact same time. There's no lag.
So why has it gotten this tight? Is it just technology? Is it the speed of information?
That's part of it, but it's more the nature of global capital flows now. The Western financial system has become so integrated and so reactive to the same central bank policies, specifically the Fed, that all the nuance has vanished.
The Fed is the global central bank.
It is. The plumbing is connected. And this is the crucial context for why we are seeing capital flee to other assets.
Yeah.
If you can't diversify by geography within the West, you have to leave the West entirely, or you leave equities entirely.
Which leads us perfectly to the dollar, or rather the flight from the dollar.
Yep.
Because if the U.S. and Europe are basically one giant trade and people are nervous about that trade, the currency that underpins it all has to take a hit.
The greenback is having a really, really rough time.
The report calls it malaise, which sounds like a Victorian illness, but for a currency is pretty serious. We're looking at the dollar index compared to a year ago. It was at 110 points strong, dominant.
That's dollar.
King dollar. And now it's significantly weaker. Why is the world suddenly dumping the dollar?
It's a combination of factors, but they all circle back to this fracture concept we've been talking about. First, you have U.S. isolationism. With the rhetoric shifting to sell America, international investors are taking that advice literally. They are cutting their exposure to U.S. assets.
Sell America was supposed to be a political slogan, not, actual investment advice from the government.
The market doesn't distinguish between the two. The market hears signals. If the political stance is hostile to global trade or implies that the U.S. is going to prioritize domestic policy over global stability, capital leaves, it goes where it feels treated best.
Makes sense.
Second, you have the debt concerns, which, they never really go away. The U.S. debt pile's massive. But third, and most immediately, is the expectation that the Fed is going to keep cutting rates.
And lower rates usually mean a weaker currency because you earn less interest holding it. That's like standard textbook stuff.
Generally, yes, it's the simple interest rate differential. But there's an anomaly here, a big one, the Japanese yen.
The yen. I feel like we haven't talked about the yen as a powerhouse in Decades. It's been the sick man of currencies for so long.
It's been the widowmaker trade for a long time. People have lost fortunes betting on the yen coming back. But suddenly, here we are in 2026, and the yen is the star of the show.
So what's happening?
It's hit a 3-month high. It's acting stable while the dollar is wobbling. And there is some really juicy speculation in the source material about why.
Yeah, let's talk about this joint intervention because that implies collusion. That's a big deal.
Collusion or cooperation, depending on your perspective. There's a rumor, and the market price action backs it up, that we might have seen a joint intervention by the U.S. and Japanese authorities.
We haven't seen that kind of coordinated move since
When?
the tsunami in 2011.
Exactly. It's a crisis-level action.
Wait, so things are unstable enough that former rivals, or at least heavy economic competitors, are teaming up to physically manipulate the currency price.
Precisely. It signals that the volatility was getting out of hand. The U.S. Treasury and the Ministry of Finance in Japan likely looked at the charts and said, okay, this is moving too fast. We need to step in and put a floor under this.
Wow.
But here's the kicker. Jefferies, the investment bank, is predicting this isn't over. They see the yen strengthening all the way to 150 against the dollar.
To 150. That is a massive move from where we were last year. I mean, that's a total repricing of the relationship.
It is, and it's driven by the spread. The Federal Reserve is cutting rates, or expected to. The Bank of Japan is finally, after decades, hiking rates.
Great divergence.
It closes the gap that made the dollar so attractive for so long. The carry trade, where you borrow cheap yen to buy expensive dollars, is unwinding. And that unwinding creates a vacuum that sucks value out of the dollar and pumps it back into the yen.
So if the dollar is out and the yen is in, there is still one asset that is beating them all. It's not paper. It's not digital code. The report calls it the golden age.
Section 2, the barbarous relic, makes its return.
The numbers here are, frankly, historically high. We are looking at gold trading near $5,110 an ounce.
Unprecedented territory. It's just a vertical line on the chart.
I remember when $2,000 seemed like a psychological barrier we'd never break. People said $2,500 was the absolute ceiling. Now we are at $5,110. And it's rallying beyond just tariff fears or tech jitters. It's up another 1.36% in just the trading session covered by this report.
The price action is aggressive. But the why is more important than the how much. We have to ask who is buying. Because retail investors, buying a few coins for their safe is one thing. That doesn't move the global spot price like this.
No, this is whale activity.
It's the central banks. It's the biggest whales of all. Jefferies put out data showing that foreign central bank reserves in gold have risen to 30% of their total holdings.
30%.
At the same time, their dollar reserves have dropped to 40%.
That's a huge swing. They're literally swapping stacks of $100 bills for gold bars.
They are de-dollarizing in real time. This isn't a conspiracy theory from some blog anymore. It's a balance sheet reality you can see in the official data.
The report mentions the Central Bank of Poland specifically. Why Poland? What's the significance there?
Well, geography is destiny, right? Poland borders Russia and Ukraine. They're on the front lines of the fracture.
The hot zone.
The absolute hot zone. In Q4 of 2025 alone, they bought 35 tons of gold. That is a massive amount of physical metal for a single quarter. And you have to understand, they aren't buying it for speculation.
No.
They're not trying to flip it for a profit next month. They are buying it for survival. It's an asset of last resort.
If the currency system fails, gold still buys bread and oil.
Exactly. If the digital banking system goes down, or if you get sanctioned by a superpower, or if the dollar collapses, gold is the only thing that is truly yours. It has no counterparty risk.
But it's not just nations. This next part really surprised me. Tether, the cryptocurrency stablecoin company, bought 27 tons of gold in the same quarter.
That is fascinating, isn't it? I mean, think about the irony. You have the oldest form of money gold being accumulated by the newest form of money crypto.
It seems completely counterintuitive. Crypto was supposed to replace gold as the non-government asset.
It was supposed to, but in this environment, they are converging. It validates the thesis that this is about escaping the traditional fiat currency system.
Right.
Whether you are a central bank in Warsaw worrying about tanks on the border, or a crypto issuer in the cloud worrying about regulators and banking collapses, you don't trust the dollar right now. You trust the metal. Tether is essentially backing its digital tokens with physical atoms.
So where does this go? Are we at the top? I mean, $5,100 feels like a peak. It feels like a blow-off top.
The experts don't think so. They think we're just getting started. Societe Generale has raised their target to $6,000.
6,000.
Goldman Sachs is at 5,700.
$6,000 gold. That changes the math on everything. I mean, jewelry, electronics, industrial uses.
It does, and Rosenberg Research had the most interesting take on why. They called gold the only really malleable metal.
I like that line. And they don't mean physically malleable, like you can hammer it into a ring?
No, they mean financially malleable. It can be whatever you need it to be. If you're worried about inflation, gold is a hedge. Worried about geopolitical chaos, gold is a hedge. Worried about a crashing dollar,
Gold is a hedge.
it's a hedge. It's the Swiss Army knife of financial safety. And Rosenberg's view, the really important part, is that the diversification process, the shift we saw from 40% dollars to 30% gold in central bank reserves, is only halfway through.
Only halfway.
That implies the rally has massive legs. If central banks are only half done dumping their dollars for gold, there is a tsunami of buying pressure left in the pipe. We could be looking at a multi-year bull market that redefines what we think money is.
Okay, before we leave commodities, we have to touch on silver. Because usually where gold goes, silver follows. But the source calls silver a meme stock.
It really behaves like one. It's incredibly volatile. While gold is steadily marching up like a disciplined soldier, silver is swinging wildly like a gambler in a casino.
Yeah, the numbers are wild.
It's down 5% in this report, trading around $109, but just the other day it swung 12% in a single session.
A 12% swing in a commodity, that's crypto volatility. That's Dogecoin behavior.
Exactly. It's speculative frenzy. Because silver has industrial uses, solar panels, electronics, it's tied to the real economy in a way gold isn't. So you get this clash between safe haven buying and recession selling.
And the result is chaos.
The result is chaos. Gold is for safety. Silver is for gambling right now. That's the takeaway.
Okay, let's pivot. We've talked about the money moving, but now we need to talk about the goods moving. Or not moving. Section 3, the geopolitical chessboard.
This is where the rubber meets the road, or the ship meets the blockade.
And the headline here is something that I feel like U.S. media is totally sleeping on. While we're obsessed with our own elections and weather, the EU and India have just signed what the report calls the mother of all agreements.
It's huge. It's genuinely historic. We are talking about a trade deal that covers 25% of global GDP and a third of all international trade.
That is massive. But help me understand the timing. These things usually take forever.
It did take forever. It took 2 decades to negotiate. 20 years of bureaucrats arguing over, cheese and textiles and visas.
So why sign it now? In January of 2026, what was the catalyst?
Because of the fracture we talked about earlier, Europe is terrified. They are seeing the U.S. pull back, they see the tariffs coming from the Trump administration, and they realize they are exposed. They need a new market. They need a counterbalance to the rupture in transatlantic relations.
So the headline in the report is, diversification is the name of the game.
Precisely. If the U.S. market is becoming hostile with tariffs, where do you go? China is tricky, relations there are tense, Russia is closed off. You go to India, Europe needs 1.4 billion Indian consumers, and India needs European investment. It's a marriage of necessity.
Let's look at the terms because they are aggressive. India is slashing tariffs on European cars. Luxury cars used to have a 110% tariff.
Which is basically a ban.
A ban, right. And that's being cut to 40%.
That is a game changer for German and Italian automakers. Think about Mercedes, BMW, Ferrari. They've been struggling with slowing demand in China. Suddenly, a new middle class in India is accessible. 110% tax meant nobody bought them. A 40% tax, that's manageable for the wealthy elite in Mumbai and Delhi. It opens up a revenue stream that was previously dammed up.
And in return, India gets to export more to Europe. Is that the trade-off?
Yes. The forecasts say Indian exports to Europe will rise to $42 billion by 2031. It's a massive win-win that completely bypasses the United States, and that's the key point. The world is organizing itself around the U.S., not necessarily with the U.S.
It's also interesting to see the red lines they drew. India protected its agriculture. Europe protected its intellectual property.
Classic negotiation. India can't afford to have its hundreds of millions of farmers wiped out by subsidized European imports, and Europe can't afford to have its tech stolen. But the fact that they found a middle ground, that they actually got it done after 20 years, signals that the EU is deadly serious about decoupling or at least hedging against the U.S. They are building a lifeboat.
Speaking of the U.S. making friends and influencing people, let's talk about Trump and the tariff wars. Specifically, the situation with South Korea.
This is a classic example of the shadow president negotiating style. It's textbook.
So the threat is, Trump is threatening to hike tariffs on South Korean goods. We're talking cars, timber, pharma, from 15% to 25%. And the reason, Seoul hasn't ratified a trade deal yet.
Right. It's a threat. Sign the paper or pay the tax. It's blunt force trauma negotiation.
But here's what's fascinating to me. The market didn't care. The Kospi, the Korean stock market, actually went up 2%. Hyundai and Kia took a little dip, but recovered almost immediately. Why aren't they panicking?
This tells us something very important about how the market views these threats in 2026. They see it as negotiation theater.
Just noise.
It's just noise. The market knows that South Korea is a major partner, a $130 billion interchange. They know the ratification is already scheduled for February anyway. So when Trump threatens tariffs, the market says he's bluffing. It's just a tactic to get them to hurry up. He needs their chips in their cars more than they need a tariff break.
That's a dangerous game of chicken, though, ignoring the President of the United States.
It is. But so far, the market is betting that the bark is worse than the bite, at least with key military allies like Korea. Now, if this were China, the reaction might be very different. But with Korea, they think it's just a tactic to speed up the paperwork.
Meanwhile, the UK is trying to walk a very, very thin tightrope. Keir Starmer is visiting China for 3 days.
And he's out there saying, I will not be forced to choose.
Good luck with that in this environment.
Exactly. In a fractured world, not choosing is rarely an option for long. Visiting China risks agitating President Trump. It risks alienating the U.S. security apparatus. But the UK economy is struggling. They need trade. Everyone is scrambling for position before the ice fully cracks. Starmer is trying to have his cake and eat it too, but the geopolitical table is shrinking fast.
Speaking of ice, let's bring it home to the U.S. Section 4, the domestic landscape.
Yeah.
And I mean literally ice.
Yes, the ice storm. It sounds like a disaster movie, but it's an economic reality.
We have a massive ice storm paralyzing parts of America, and the economic cost here is just staggering. CNBC is estimating up to $100 billion in damages.
To put that in perspective for you, that's larger than the GDP of many countries. Bank of America says it could shave between 0.5% to 1% off the entire Q1 GDP of the United States.
So a full percent.
A full percent. That is a massive dent.
That sounds like a recession trigger. If you knock 1% off growth in a single quarter, aren't you risking a contraction?
Well, here's the nuance. And economists love this nuance. They say this GDP isn't canceled, it's delayed.
Okay.
The economy stops while the ice is there. Nobody goes to restaurants. Factories shut down, deliveries stop, but then you have a reconstruction boom. You have to fix the power lines, repair the roofs, buy new cars to replace the ones crushed by trees. So you get a dip in Q1, but potentially a boost in Q2 or Q3.
The broken window fallacy in action.
Exactly. It stimulates activity, but it's spending money just to get back to zero, not to move forward. It's painful, and it's inflationary in the short term. The price of lumber, labor, and roofing materials is going to spike in those regions.
And it's not just the weather that's frozen. The government is looming towards a shutdown again.
It's the eternal dance. A partial shutdown looks inevitable by Friday. And it's the usual sticking point, isn't it? Immigration.
Always. The Democrats want to separate funding for federal agencies from Homeland Security.
Which includes ICE funding.
Right. And Republicans say, no way, it's all or nothing. And amidst all this, Trump is sending his border czar, Tom Homan, to Minnesota.
This is interesting because of the relationship dynamics. Minnesota isn't exactly Trump country in terms of local leadership, but Trump and Governor Walz, they actually had a surprisingly cordial phone call.
I saw that.
Trump posted on Truth Social that they are on the same wavelength.
Which is shocking given the rhetoric we usually hear, Walz and Trump agreeing on anything.
It shows that behind the scenes there's pragmatism. When a crisis hits like the ice storm or the border issues, ideology sometimes takes a backseat to logistics. But it also reinforces this idea of Trump as the shadow president. He's making the calls, sending the envoys. Even if the official machinery is gridlocked, he's operating parallel to the actual bureaucracy.
Let's pull on that thread.
Yeah.
The shadow president and the Federal Reserve. This is probably the most critical part for investors listening right now.
Without a doubt, the Fed is the engine of the market. And right now, people are wondering who is actually driving the car.
The FOMC meeting, the Fed meeting, starts tomorrow. So first one of 2026. Now, officially, the Fed is independent. Powell and the board, they decide rates based on data.
That's the theory.
That's the theory. But Wall Street seems to think the real power isn't in the Fed building anymore.
No. The sentiment on the street is that while the candidates for the Fed are fairly dovish, the shadow President Trump is calling the tune. The market believes that fiscal policy, so government spending and monetary policy, rates, are being forced into alignment. The idea of an independent Fed fighting the administration, that seems to be fading.
We have a quote here from Rick Reeder at BlackRock. He's a heavyweight. He manages trillions of dollars, and he's saying rates should be 100 basis points lower, a full percent lower.
He is aggressively dovish. He thinks the Fed is way behind the curve. He wants them to be more innovative with the balance sheet.
Which is code for what? Print more money.
It's code for print more money or buy different assets. But then he drops this line that I'm still processing. This is the best environment I have ever seen to invest.
That stopped me in my tracks, too. We have ice storms, global fractures, trade wars, gold at over $5,000. And he says it's the best environment. Is he delusional?
It sounds contradictory, but think about it from a trader's perspective. If you know rates are coming down, if you know the government is going to be pumping stimulus and reconstruction money, and if companies are innovating in AI, that creates massive opportunity.
So the chaos is good for him.
Chaos is a ladder, right? Volatility creates mispricing, and guys like Ryder make their money fixing mispricing. He sees the disruption as a chance to buy quality assets at confused prices.
There's also a wild theory from Wolf Research about this meeting. They think the nominee for the next Fed chair might be announced during the FOMC meeting.
That would be the ultimate power move. Can you imagine that? Announcing the replacement while the current board is sitting in the room debating rates? It's disrespectful, but it's brutally strategic. It's designed to distract.
Distract from what?
From the lack of a cut. See, Goldman Sachs predicts the Fed won't cut rates tomorrow. If that happens, the market might tank. But if the administration announces, here's the new guy who will cut rates in June, it controls the narrative. It keeps the market happy, even if the current decision is bad news. It tells the market, don't worry about today, help is coming.
It's psychological warfare with the central bank.
It is, and it just underscores that politics and finance are now inseparable. You cannot analyze the S&P 500 without analyzing the White House. The barrier is gone.
Okay, let's move to the engine room of the economy. Section 5, the tech earnings deep dive. Because while the politicians are playing chess, the tech companies are building the board.
Follow the money. That's the mantra.
And what's interesting is the observation that the Mag 7, the Magnificent Seven tech giants, are evolving. We aren't really seeing them as just tech companies anymore.
No, they are holding companies. They are conglomerates. And the market is rotating out of them as stocks people taking profits because they've had a huge run. But the companies themselves are becoming more powerful than ever. Wall Street doesn't care about their subscriber numbers as much as their capex.
Capital expenditure, how much cash they're burning on new projects.
Exactly, and the numbers are just astronomical.
Let's break down the must-knows for our listeners. Let's start with Meta, Facebook.
Meta is fascinating right now. The headline is that $108 billion number.
$108 billion in spending.
Yes, investments are increasing 50% year over year. They are dumping $108 billion into AI chips, data centers, and the energy infrastructure to power it all.
That's more than the GDP of most nations. What on earth are they building?
They are building the infrastructure to run the world's social graph on artificial intelligence. They want AI to generate the ads, manage the communities, and, frankly, keep you addicted. They are betting the farm that AI isn't a feature. It's the operating system of the future internet.
And there's a scoop here about a subscription service. This is new.
Yes, this is the monetization play. Rumors are swirling that Meta will announce a subscription for Instagram, Facebook, and WhatsApp, not just for no ads, but to unlock advanced AI features.
Like,
imagine having a personal AI assistant integrated into your WhatsApp that actually works, that can book travel for you, manage your calendar, talk to businesses for you. That's what they're building.
that changes the business model completely. From ad-supported to SaaS, software as a service.
Exactly. It stabilizes revenue and makes them less dependent on fickle advertisers who pull back during recessions. If they can get 1 billion people to pay $5 a month, the math becomes incredible.
Okay, next up.
Microsoft.
Microsoft is making a hardware move. They are announcing the Maya 200, their second-generation AI chip.
Why does a software company need its own chip? Why not just buy from NVIDIA like everyone else?
Independence.
Yeah.
And margin. Right now, everyone is addicted to NVIDIA chips.
Yeah.
And NVIDIA charges a massive premium. Their margins are, 70 or 80%?
Insane.
Microsoft wants to break that dependency. They're building their own silicon to run their own data centers. It's about margin control. If you own the chip, you keep more of the profit. It's strategic sovereignty, just like the countries we talked about earlier. Speaking of keeping profit, Tesla. This is the one that really caught my eye in the report.
Tesla is the wild card. It always is.
The sales numbers, on the surface, they aren't great. Q4 sales were down 22%. Meanwhile, the dinosaur's VW, Stellantis, saw their EV sales rise. So Tesla is losing market share in cars. The core business is shrinking.
But the stock story isn't about cars anymore. If you're analyzing Tesla as a car company, you're missing the point entirely. It's all about the SpaceX merger.
This sounds like science fiction. A reverse merger of SpaceX into Tesla. Is that even possible?
It's the rumor that will not die. SpaceX is valued at, what, $1.5 trillion? It is dominant in space launch, dominant in satellite internet with Starlink. If Elon Musk merges that into Tesla, suddenly Tesla isn't a struggling car company. It's the world's dominant aerospace and internet company that also happens to make cars.
It solves the growth problem overnight.
Instantly. It injects $1.5 trillion of value and a monopoly business space into the public company. And Ron Barron, the famous investor, is out there predicting Tesla stock hits $10,000 in 10 years.
$10,000 a share.
Based on Optimus, the robot. Again, it's not about the car, it's about the holding company. Robotics, space, AI, energy. The car is just one product line in a much bigger portfolio. He views Tesla as an industrial conglomerate, like GE in its prime, but for the 22nd century.
It's a conglomerate of the future.
Precisely.
Let's hit a few more quickly. IBM, the old giant.
The quiet achiever. They have completed their transformation. Over 50% of their business is now software and services. They aren't a hardware dinosaur anymore. Evercore and Jefferies both upgraded them. It's a boring, profitable, pick-and-shovel play for the AI age.
How so?
They help other companies use AI. It's not flashy, but it prints money. They're the ones selling the tools to the gold miners.
And Apple.
Resilience. They proved their supply chain is bulletproof during all the global crunches. Now the focus is on the iPhone 17 and the rumors of the foldable iPhone 18. But the real key, the thing to watch, is the Gemini partnership.
Integrating Google's Gemini AI into the iPhone.
Yes. That makes the iPhone the user interface for AI for billions of people. Apple doesn't need to build the best model. They just need to own the screen you use to access it.
And finally, the king, NVIDIA.
NVIDIA is just unstoppable. They're investing another $2 billion in CoreWeave.
CoreWeave is the cloud provider, right? The upstart competitor to Amazon and Google.
Yes. So NVIDIA is basically funding its own customers. They give CoreWeave money. CoreWeave turns around and buys NVIDIA chips.
That sounds a little circular.
Some critics call it circular. NVIDIA calls it ecosystem building. They are ensuring there is somewhere to put all the chips they're making. The goal is 5 gigawatts of computational capacity by 2035.
5 gigawatts.
That is an insane amount of power. That's more power than some small countries consume, dedicated just to AI.
And Jensen Huang is in China. What's he doing there?
He is. And this is the part the market might be underpricing. He's making deals in China that aren't even in the guidance yet. He says demand is so high they can't keep up. And CoreWeave gets the first access to the new Vera CPUs. NVIDIA is building the physical infrastructure of the digital age. They are the Standard Oil of 2026. They own the pipes, the refineries, and the oil.
It's breathtaking when you lay it all out like that. These companies are operating on a scale that really does rival governments.
They really are. They have their own foreign policies, their own industrial policies.
So we've covered the macro fracture, the golden rally, the trade wars, the shadow president, and the tech titans. Well, let's try to synthesize this. What is the connected world telling us?
It's telling us there is a massive contradiction at the heart of the global system right now. On one hand, geopolitics is fracturing. Nations are putting up walls, tariffs, and lines in the sand. The world is getting smaller and angrier. But on the other hand, the markets are more connected than ever. That 98% correlation between the US and Europe is the proof.
So the politicians are pulling apart, but the money's all stuck together.
Exactly. And that tension creates the volatility. The financial system is trying to globalize while the political system is trying to localize. And the shadow Fed concept reinforces this. Politics and finance are crashing into each other. There's no separation.
So what is the takeaway for the listener, the person driving to work or hitting the gym right now? What do they do with all this?
First, don't fear the volatility. See it as a signal. It's the sound of the old guard changing, and that creates opportunity. Second, watch the CapEx numbers. Ignore the daily stock price of Meta or Microsoft. Look at how many billions they are spending on infrastructure. That is where the future economy is being built, brick by brick, server by server.
And gold. Is it too late for gold?
Gold is no longer for doomers. In a fractured world, it is a strategic necessity. It's the only asset that doesn't rely on a government's promise or a CEO's execution.
I want to leave everyone with a final thought, something that came to me while we were prepping this.
Go for it.
If the correlation between U.S. and European markets is 98% and the dollar is facing an existential fracture, where is the real safe haven? Is it gold at over $5,000? Or is it possible that the real safe haven is the AI infrastructure being built by companies like Microsoft and NVIDIA, companies that are now larger and perhaps more stable than most countries?
That is the trillion-dollar question. The Sell America rhetoric might just be the buying opportunity of the decade if you pick the right holding company.
A nation state of one. Thanks for listening to The Deep Dive. We'll see you on the other side of the fracture.
Stay curious.